Hey, Thomas Castelli back here again for another episode of Tax Smart Q&A. And in this episode, I'm going to answer the question, what are the top 3 biggest mistakes short-term rental investors make when using the short-term rental loophole? If you're not already familiar, the short-term rental loophole allows short-term rental owners who have an average stay of 7 days or less on their property and materially participate in their short-term rental to take the losses from the short-term rental and use it to offset their active W-2 or other business income, which has the potential to save you tens of thousands of dollars in taxes. However, there are a few critical mistakes short-term rental investors make that are preventing them from using the short-term rental loophole and end up costing them thousands of dollars in tax savings. Before I break down these top 3 mistakes, if you do like this video, be sure to hit the like button to help get this video into the hands of more real estate investors and help them become tax smart. Generally speaking, if you or your relatives use the property for more than 14 days, then the house will typically be considered a residence, and losses on residences are limited to the income that the property produces, which means you cannot use the loss to offset your W-2 or other active business income. So the second biggest mistake is having an average stay of greater than 7 days or 30 days if you provide substantial services. So the way the short-term rental loophole works is it's not considered a rental activity, which means you do not need to become a real estate professional as long as the property has an average stay of 7 days or less or 30 days or less if you provide substantial services such as hotel-like services you would find in a hotel. So if your property has an average stay of greater than 7 days or 30 days if you provide substantial services, then your property will be considered a long-term rental and it will be considered passive by default, which means unless you qualify as a real estate professional, the losses will be passive and you will not be able to use them against your W-2 or other active business income. If you're ever pulled for an audit, the responsibility to prove that you met the requirements of the short-term rental loophole will be on you. And that includes the thresholds we just mentioned above, as well as the fact that you materially participated in the activity. Now, for the most part, your listing software such as Airbnb, VRBO are either directly going to be able to tell you the average stay, or you're going to be able to export it and easily calculate that and have that for your records. However, when it comes time to documenting your time, the time you spent on the short-term rental activity for the purposes of passing one of the 7 material participation tests, that's going to be solely on you to document. Now, you can use calendar systems, you can use tracking applications, or you can use a simple spreadsheet, but you're going to want to document your time so that you can prove that you met one of the 7 material participation tests. Because if you cannot, then the IRS will argue that you have a passive activity and you will not be able to use the losses from your short-term rental against your W-2 or other active income. One more thing too, if you do use the 100-hour material participation test, you're not only going to need to track your time, but you're going to need to track the time that other people spend on your property to prove that you spent more than 100 hours and no one else spent more time than you. That's all for today's video. If you want to learn more about the short-term rental loophole, go ahead and grab our free guide linked in the description to this video. Also, if you do want to see more tax smart videos, be sure to subscribe to the channel so you don't miss out on future releases, and we'll catch you on the next episode of Tax Smart Q&A.